Hi, I'm joined by Philip Richards, Senior Banks Analyst at BI, to have a quick chat on the outlook for European banks for the rest of 2023. And it has all been about banks lately, hasn't it? And we do have an awful lot to unpack in a relatively short period of time. So to set the scene, here's a few data points. Firstly, the KBW Banks Index is down around 30% since SVB blew up, and it's lagging the S&P 500's broader rise. The SX7P, conversely, is only down around 11%, having decently rallied from its lows, and even Warren Buffett has seemingly cooled on banks and exited from some of his holdings. So with that all in mind and the results season now behind us, and the market now pricing in peak interest rates, what's your views on European banks' earnings going forward, Philip?
Yeah, thank you, Rod. And I agree. It has been a bit of a roller coaster ride covering European banks in recent months. And of course, triggered by Russia's invasion of Ukraine and the resulting surge in inflation, ECB policy rates soared to 3% and higher after an unprecedented 8-year spell of negative rates. And that's really been a boon for bank revenues, which based on full year 2023 analyst estimates, surged 15% since the start of last year. Now, of course, inflation has also increased and therefore pushing up costs about 8%, and bad debts are expected to rise with a pending economic slowdown. But pre-tax profits are still expected for the banks to be about 25% higher than what was expected a year ago. And that really drove a 45% rally in bank share prices through to the end of February, ahead of the regional bank crisis coming from the US. Now, however, where we're at today, with expectations now of interest rates to be at or near peak levels, credit qualities start getting worse, and economic conditions are deteriorating. So we believe we are now at the end of that earnings upgrade cycle, and pressure is growing on the banks to pass on more of those rate hikes to depositors, which in turn will squeeze bank margins and could see revenue estimates edging lower. And that was a key theme from the recent 1Q result.
Now, you mentioned credit. How concerned should we be about that? You mentioned previously robust credit quality, but on both sides of the Atlantic, banks are reining in lending. How's that going to affect profitability?
Well, past experience would tell us that with soaring interest rates and a weaker economic outlook can only really lead to one thing, which is a deterioration in credit quality and therefore a rise in credit costs. Now, we didn't see that with 1Q reports, but it may just be a timing issue because households are partially protected while on fixed rate mortgage contracts. But of course, as they roll off and people have to refinance onto much higher rates, that's where we may see some of that financial pain starting to trigger through.
Understood. And then finally, you note a couple of further challenges in terms of commercial real estate exposure and deposit outflows. Are these twin risks likely to rear their heads in the second half of this year?
Well, those risks are indeed present, but are much harder to determine with any sort of degree of confidence. Now, European banks are highly exposed to commercial real estate. Aggregate exposure for the lenders is about 680 billion euros. And of course, pressure is growing, and particularly within the office segment, with the whole work from home trends. However, for example, average loan to values for banks on that exposure is only about 50%. So prices would need to fall by an average about 50% before collateral values drop below the value of bank loans, which would really be a very extreme outcome. And in addition, banks typically have very diversified portfolios across asset classes, geography. So even if there are losses in one market, overall the share of total for the banks is quite more limited. Now, deposit outflows did hit the US banks, but we don't expect that to cause a liquidity crisis for the European sector. They give much more robust liquidity oversight for the banks versus those smaller US lenders, which tend to fall under the radar of the US authorities. Also, but those banks' shares of uninsured deposits were much higher than what's typical in Europe. And European lenders' deposit bases are much less concentrated than, say, for US banks, which reduces that risk of outflow. However, banks may well need to pay out those higher retail deposit balances, which will affect margins and therefore revenue outlook. So we see it more as an earnings risk to the banks rather than potential deposit outflows.
Understood. Well, thank you very much for your time and your insights, Philip. Much appreciated.
Thanks.